Welcome to the Royal Tax Podcast with your hosts, Megan Templeton, Royal Legal Solutions Consulting Attorney, and Royal Legal Solutions CPA, MBA, and CFO, Pete Schindele. Each week, they talk about how to take your tax and financial strategy to the next level and learn how to build and scale your real estate investing business in a way that maximizes your returns and minimizes your taxes. This is for informational use only. For direct questions, please contact us or your local tax CPA accountant.
Hi, everyone, and welcome. Of course, I am Scott Royal Smith. I'm the owner of Royal Legal Solutions, your one-stop shop for everything entrepreneur and real estate investor related for asset protection, tax, and estate planning. I'm here with Pete Schindele. He's our CPA, MBA, our international man of mystery of all things tax. And today we are going to be talking about the S Corporation. And I'm very excited to share with you all of the amazing benefits that these S corporations or LLCs, tax S corporations, can allow you to do to save money on taxes, but also help protect you. So let's just go ahead and have a quick review of some of the structuring to remember how do the S corporations, these operating companies, relate to the overarching structure. And then we'll go ahead and pop in with Pete to start asking Pete some questions here about some of the tax benefits related to those S corporations. All right, guys, so we're shifting over here to, you guys will remember here is that the one thing we always have here is where you're going to establish an asset holding company. You don't want to be like my friend who had all of his assets in his personal name and is very well insured and lost over $3 million in real estate because he neglected to have an asset holding company. So we should always have insurance, but we never depend on insurance because insurance companies are good at collecting premiums and even better at denying coverage. And remember, we have this asset holding company. Typically, we're looking for this to be a series LLC or a DST or just one or more LLCs. And the basics of your asset holding company is you'll have like a parent entity here of some sort, and then you have individualized compartmentalized entities. If this is a series LLC structure, a DST, these would be like a child series. If you're using an LLC, like in a hub and spoke model, this is typically like a Wyoming LLC up at the parent and then individual LLCs down below. So one way or another, you're compartmentalizing your liability. You're going to be using trust structures underneath your asset holding companies as your compartmentalized assets to create anonymity on the asset holding front. And this is where you're going to be holding your individual assets. It's either going to be you're holding, your piece of real estate, or here you're holding like a note. Here you might be like holding like a sailboat. Anything in your life, so that way you should not own assets anymore, right? You should own a company which owns the assets, as you have here. So this is your asset holding company. It's what owns everything and does nothing. It's an anonymous company that owns assets anonymously. Separate and apart from your asset holding company is your operating company. And this operating company does everything. It's your face to the world, but it owns nothing. So this is typically like an LLC, an S Corp, or in some situations, we can see this being a C Corp, depending upon what your tax situation needs to be. But for this today, what we're going to be talking about is if we want to have this as an S Corp, or if we want this as an LLC, that's taxed as an S Corp. Those are the tax advantages we have today. Your operating company is either going to take in funds like independently because it's doing some type of business, right? So this could just be any type of active business that you have. Maybe you have your online store selling stuff like really cool bracelets on Etsy or whatever the case may be. Or what it could be is that you're taking your income that you make from your rental property here, right? A rental property here, and that we're taking the money and we're channeling up through this operating company and saying this operating company here is providing some type of service. This service could be some type of like investment advisory service. It could be a property management service, could be any type of service, but it's taking that passive income here and it's translating or transmuting that income into active income through the business that this corporation is engaged in. And then ultimately, you guys know this is where we could take money and push it into a solar 401k to help avoid taxes. So who is this going to be important for? This is important if you're an entrepreneur and you're making money and 1099 money or self-employed money, and you want to save money on your taxes. That's going to be using that S corporation. It's going to be for people that want to take rental money, and instead of paying taxes on their rental money, taking it and pushing it into a retirement account, and a way for them to do that as we come into it. Now, important to note that your rental income is going to be offset by your depreciation in your properties, just outright from that. So you won't need to do this strategy if that's already the case for you. If you're already at zero taxable income after you take your depreciation out, then you won't need to do this. But if you have positive income and you want to avoid paying taxes on it from your rental property, this is a strategy to do it. Or if you have other income out here, that's your 1099 or self-employed income, and we want to help avoid paying taxes on it. Pete, anything to add about the diagram or the picture of the structure before we dive into tax benefits and how those work?
Want more information? Join our community groups that exist to provide a space for like-minded people on a similar journey to learn, share, and network with real estate investing professionals and entrepreneurs. We meet weekly for an hour in Zoom to offer knowledge and accountability. Be sure to grab the link in our show notes.
I think your diagram covers it all, going from a real estate investor or just an outside entrepreneur.
Cool. So tell us more, like a little bit more about that, Pete. Like who are you seeing that's really would benefit from using this type of structure, using an LLC tax as an S corp or a straight up S corp?
So the LLC tax as an S corp or just an S corp straight up, the people that benefit mostly about that would be individuals who rent those properties are producing income above depreciation of about 40,000 is kind of the threshold. Or if you're a 1099 and you're making income above 40,000, doing an S corp is a really good way to save money on taxes. And the main reason is due to the W-2 wage and then the shareholder or the net profit of the S corp.
All right, so let's take one step back real quick. So
Okay.
what'll happen is if you don't have an S corporation put in place, what kind of taxes are you paying on that income?
So right off the bat, you're paying the employee taxes and employment taxes, which is about 15%. So for example, if you make $100,000 and you have it just as an LLC or a 1099 and run it through a Schedule C, you are going to pay $15,000 employment tax, about
15%, right?
15%. So 15,000 of the 100,000. So half of that's the employer portion of the employee tax, Social Security, unemployment, and then the other half is the employee portion. So that's how you get to that 15%.
And so when you're saying so that would be, I think it's like that 15%, 15.3%, whatever it happens to be, right? It's 15 point something.
Correct.
As I come into it. We'll use round numbers because those are easy for us here. Into it. So when we're talking about it as say, great, well, now we have that income. We're going to push that income through the S corporation, right?
Yep.
So now the money is owned by the S corporation, and then the S corporation is going to pay you, Pete, right?
Correct.
And what ways does the S corporation pay you?
So one way is a W-2. So, that is a W-2 where the S corporation will pay 7% of the employer tax. And then out of the W-2, you'll have the 7.6% withheld. Just kind of, if you've had a normal job before where you worked for a company, just the same process as a W-2. The other way to get money out of an S corp is a distribution of profits at year end. And those profits aren't considered wage. So by being a distribution, that's not a wage, you don't have to pay the 15.3% employer and employee taxes on. So for example, going back to $100,000, if that's what you're making consulting or through your property rentals, if you pay yourself a reasonable wage at $40,000, that $40,000, you'll pay that 15% in employee taxes, employer taxes. But that $60,000, you can take as a distribution, and that avoids that 15.3% employer-employee tax. So right off the top, if you went that approach, you'd be saving anywhere from $6,000 to $10,000 in taxes.
I mean, it looks like if we just crunch some quick numbers here, right? We're talking about like paying 40,000. We just multiply that by our 15% there. That takes us down to like a $6,000 total tax liability from a $15,000 tax liability, right? And so that that other 15%, that 15% that you're paying now on the 40,000, that covers like your Social Security. It covers all of those other pieces that you would typically otherwise be paying wages on. So when you go with this strategy, if I'm understanding you right, Pete, what you're able to do then is say like, well, we're going to take, probably like 60% of your money, and we're going to pay that out as basically like a dividend or a distribution of profits because of your ownership in the S corporation. That's not subject to the 15% tax. But hey, we still need to pay you a wage at some type of the lowest possible amount of wages that we can reasonably pay you for the work. And that amount of wages, we do have to pay that 15% on.
Correct. And that's where, if you wanted to determine what type of minimum wage you want to pay, you can just Google Indeed. You can just look at job postings for similar jobs out there, and you can take screenshots. You can print that out, and you can kind of keep that in a file to show this is how I came up with my reasonable wage.
Absolutely. Yeah, you can do those reasonable wages. There's a wide spectrum of what you can use for that, right? For whatever you're doing. Yeah. So like you'd think like a reasonable wage is oftentimes a lot lower than you think it could be, because you can take the wage of anybody anywhere with a similar type of role, right? So you just go to like some super small town, maybe in Arkansas, where it looks like nobody's making any money, be like, hey, that's my similar wage. I'm just like that guy. I don't want to get paid any more than them, for being able to do what this job is going to be.
Yeah.
Now, when it comes into like, when should we do this, right? Because some people would say like, hey, why wouldn't you do this at any income level? Like if you made $10,000, right? Why wouldn't you say, great, well, out of that $10,000 that I made I'm going to pay myself as a wage, $2,000, and then I'll take the extra $8,000 as assuming $2,000 is like a reasonable wage, right? And the other $8,000 I'm going to take as a distribution, because I'm going to save money on all those taxes with having to pay that 15% on that $8,000 that I'm taking out as a dividend or as a distribution of profits from my ownership in the corporation. Why wouldn't I want to do that?
At that point, the cost savings on that $8,000, it may not have the benefit to offset paying to have an S corp set up, paying to file 1120S. So you do want to do a cost benefit analysis to where sometimes it might actually be worth it to just pay the 15.3% in employer taxes, because the administration of just paying someone to do 1120S, doing a monthly payroll, having Gusto or ADP do a payroll, it could be more costly than actually paying a tax. So that's why I referenced earlier that $40,000. That $40,000 threshold is just kind of like the bare minimum bar that you want to be able to make. And then anything above that, you'd want to start implementing an S corp, because then you would start saving money. And so you can go 40,000 and then make sure you have at least another 10,000 income, so like 50. So those would kind of be your two hurdles that you want to hit before you do an S corp.
So it kind of boils down to, what is the cost of like the tax preparation to get the tax benefit you're looking for, right? Versus how much you have to pay the government. Because in some circumstances, well, you might have to, if the number's below 40,000, you end up having to pay more to get the tax prep done than you would just paying the government. So why not just pay the government? Not that we don't love making money off of filing returns, right? But the thing is, if you're not in a better position financially at the end of the day, then unless you just really hate paying the government, I totally get that too. I'm from Texas. We understand that kind of logic. We're like, well, I'd rather pay more because I just hate having to pay tax. But if you're anybody else in the world, maybe slightly more sane than us Texans out there, then you're probably thinking, well, okay, great. It doesn't matter to me who I'm paying. I just want to keep the max number of dollars. And that's usually like around that $40,000 threshold where you start seeing, great, well, that's where your break-even mark is. So if you're making more than that, then great, let's get you into the right system, and that's going to be, and now I want to be clear with everybody here too, because some people come to me and say, well, can I take my W-2 wages that I'm having, and then somehow have a benefit with the S corp, and I'm like, wait, you're missing it. Your W-2 wages, there's nothing we can do with that when it's from your 9-to-5 employer. This is for any other income that you're making, like either your rental income that we're trying to get into an S corp, or it's for, your rental income that we're trying to get into like a 401k, or your 1099 or self-employed income that we're trying to get better tax treatment than just reporting it onto your personal income. Is that right?
Correct.
Okay, cool. Any other key takeaways, Pete, of when you need to set up these entities? I know but right now when we're recording this, right, we're in December here at the end of the year. Is there any other deadlines or any other key milestones to keep in mind here when looking at whether you should implement this strategy right now?
If you could implement it right now if you want, but more likely you'd want to plan for 2022. And what's nice about 2022 starting is if you currently have an LLC and you chose it to be taxed as an LLC and not as an S corp, you can file a form in January and February to turn your LLC into an S corp for tax treatment. Or one thing I'd recommend is before you decide to do an S corp, really kind of look at your bottom line and P&Ls. And if it's around that 30 to 40,000, you can contact Scott or you can contact myself, and we can start kind of doing a scenario analysis of, this is a time to move into your S corp, because you do want to do that cost benefit analysis. And waiting till the very year end, it's going to be very hard to do.
Yeah, and then and to get the S corporation treatment at the year end, we actually need to, we're going to want to do that at the very beginning of the year. So we want to do that usually in the beginning, because usually most of the time it's easier and cheaper to form these as LLCs and have them elected to be treated differently for tax purposes than it is to form that kind of entity outright, right? So that's typically what we're trying to look for there, right? And Pete, when does that timeline again too? Can you just one more time? For being able to do the S corporation tax election?
If it's an existing entity, it's about the first 2 months of the year, so January, February. Mm-hmm. If it's a brand new entity you're creating, you can select it within about a month of that time of creation. Okay. But going back to the point, the reason you want to do it at the start of the year is you got that W-2 wage you want to pay. So you want to pay that reasonable wage the entire year, so your cash flows, so you can run your business and not just have a giant cash flow in November or December of a cash outflow to pay a W-2 wage. So by doing it at the start of the year, you can also then start setting up your solo 401k, defined benefit plan if you decide. And, those do take times. And, having 12 months, 11 months, 10 months, it's a lot easier to do that than a month.
Awesome. Yeah. So like when we're looking at setting it up here for next year, that's saying like, hey, like taking action now, because it takes about, 4 to 6 weeks to get that completed. And then we have to file the election for it. So to get it in by like the first month or two of the year, you're talking about needing to take action like now onto it to get started the process, filling out the questionnaires, having to start the filing, all that into it. So this is really timely, even for looking into 2022. I also wanted to hit on here, Pete, before we jump off today, was about, what kind of, a lot of people will ask me questions around like, well, hey, what deductions can I take? And I'm a sole proprietor and I don't have an LLC. And can I take all the deductions that an LLC can take? And isn't it, there's actually no benefits for me for doing all this extra stuff. Can you tell us a little bit about how that shakes out?
So as an S corp, similar to a Schedule C, you have your home office deduction. You have your entertainment meals where you can go out as long as you're talking business. You can write those off. You have your vehicle mileage. If you have a mileage log and you track your vehicles, or you buy a company vehicle, you can expense that through an S corp and a Schedule C as well. But the S corp really allows you to put in money into a defined benefit plan or solo 401k much easier because it's a different entity. Your C corp can do it as well, but the S corp is just kind of a cleaner transaction. And what it can also do is those lower your taxable income by your percent of your tax bracket, and those can be invested into other real estate property. But Again, they're still very similar, but I just feel you have more protection and flexibility under the S corp.
Cool. So like S corporation would be the way to go for giving you like the maximum amount of like flexibility from your end of it when you're saying, hey, what deductions are we going to be taking here? Another piece of it too that I think is from like the tax attorney part that I bring to this conversation also involves around what's our audit risk, right? So you can take in a lot of deductions, right, as a sole proprietor, and get the business deductions that you're looking for, right? Your home office deductions, your auto deductions, and a lot of ways when you're looking at disregarded entities with like LLCs, in my mind, from an audit perspective, that you say, well, great, technically you can take almost all the same things on paper, right? The deal is though, is that if you're not operating through a corporate style of entity, what we've seen is that the audit risk is actually a lot higher. That the more formalities that you put in place, the less likely you are to get audited, because the theory is that you're more professional and how do you operate your organization and less likely to defraud the government by just running a fraudulent business, right? By just saying, oh yeah, I have a business. Do you have anything at all that shows us that you're operating a business? No, I do it off my laptop and my personal cell phone and use my personal car. And I'll only use my only personal bank accounts, but I swear I'm operating a business. You see how that starts to feel kind of fishy for like anybody from the government looking at it, right? So the more that we're able to put in corporate structure and use corporate structure to be able to layer in to what are the deductions that we're going to be taking, the more aggressive we can be on the deductions. So that's where like the ROI comes in for everything that we're doing. The more structure that we put in, the more aggressive we get to play, right? So that means like if we're looking at deductions here for the S corporation, that's true in that sense. If we're going to be looking at filing some type of partnership returns because we want to be even more aggressive, cool. We pay more for tax returns, but we lower our audit risk, which means we feel more comfortable now with being more aggressive on how do we want to classify taxes, our tax expenses with that, because our chance of like having anybody review it and have to defend it is lower. Do you still need a reasonable basis for every deduction that you're taking? Absolutely. You can't lie to the government, right? And when you're looking at what things that you can claim, the more that you put in structure, the more paperwork you put into it, the more of a reasonable basis that you have upon any type of audit, right? So you guys have probably heard me talk about this in other areas as well too, which is like around like real estate professional, right? Where the people are like, well, how do I actually prove that I'm a real estate professional? There's no credentialing for it. And how do I actually show that I'm doing like this many hours? And by the way, I have like another job and other things that I work, but I want to claim real estate professional because I believe I'm entitled to it. It's like, great. Well, the thing that we do is how do we add more structure and more documentation around what this is? And the way that you do that is exactly the way you would think to do it, right? Is you start creating the documentation that shows a reasonable basis for the time that you're putting in amongst everything else that you're doing, right? And what are the dates and times and potentially what are the activities that you're doing that are associated with that, right? Now we have a reasonable basis to make the claim, right? Even if otherwise we'd be like, whoa, you're at a high risk, right? Well, you're at a much lower risk if you actually created the documentation. Same thing here, right? The more structure that you put in, the more documentation that exists, the more costs it is for you on the front end, but the more aggressive you can be on deductions. And that's the ROI game that we're playing here. And that's the difference between what it is like just doing something that's like off the shelf versus working with professionals here. And so I know this is gonna be something that we're gonna be beating into everybody's head and over the course of the year, which is about how to think like rich people think through how are they spending money, what are the ROIs that they're getting with these, and why do they do this type of work that we go with it. So Pete, any last comments on the S corporation before we wrap up for today?
Yeah, you're bringing up the audit risk was a good point, because a lot of people that file under the Schedule C, the IRS will deem those as a hobby. So if you don't have all that documentation or the S corp set up, so it is a good idea to do an S corp just for the help in the reduce of the audit risk. So
yeah, audits are expensive too. Audits are minimum $5,000 to $10,000 to be able to like defend yourself from an audit, even if you're found totally right. it still costs you that much time, plus everything else in your life shuts down. So because now you're under attack from the IRS, right? Like what else are you going to be thinking about when you're underneath it? So our philosophy is to structure everything to lower your audit risks and then make up for it by being the right amount of aggressive on what you're doing with your deductions, and to never lie about income, because if you lie about income, you go to jail, right? And we're like, jail's a non-starter, right? If we get caught on the deduction side, cool, we pay some fines, right? But we can lower our risk and do a business decision about what's our audit risk on this versus the deductions that we take. And that's thinking like rich people think. So thank you guys so much.
Thank you for listening to the show today. If you're feeling overwhelmed with taxes as they relate to your real estate business and investments, or you're unsure if you're doing your accounting correctly, fill out our 5-minute quiz. With the information from this quiz, you'll schedule a meeting with a Royal Legal Solutions advisor who will provide you with powerful tax-saving strategies on your first call. Go to www.royallegalsolutions.com/tax to fill it out.